Okay, I'm going to continue with Chapter 9. I'm going to start with lump sum purchase. So it's on page 3 of your handout, right down here. So a lump sum purchase, this one complicates it a lot, but it's kind of a neat little problem here. Woodland Developers purchases land for $1 million. It will subdivide it into 400 lots. These lots are of different sizes and shape, but we're sorted into A, B, and C lots. They sell the lots for different costs. And I need to somehow allocate the $1 million between these 400 lots. So I can't simply take $1 million divided by 400, simply because they're different types of lots, right? So we have right here, we have 400 lots. So 100 plus 100 plus 200 is 400 lots. Actually, this is all given right here. Okay, the selling price per lot is also given. The A lots, they must be better because I'm selling them for $10,000. The B lots for $6,000 and the C lots for $4,500. Okay, so if I look at those, my total selling price is $10,000 a lot for 100 of them. So that's $1 million. $6,000 for 100 of them, so $600,000. $4,500 for 200 of them. So if I get my selling price of all of them, I will sell them all for $2.5 million. Okay, but remember I need to allocate this cost to them. So what I'm going to do is I want more of that $1 million to go to the more expensive lots. So I do it based on a ratio. So I simply take the million divided by the 2.5 million. So I just ditched the last 3 zeros there. So 10 over 25. 1,000 over 2,500, 1 million over 2.5 million, times 1,000 will give me 400,000. Individual divided by the total, 600 divided by 2,500 times the million, it gives me 240. 9 over 25 times a million gets me 360. So if I've allocated it right, this better add up to $1 million. So I'm going to allocate 400,000 to the $10,000 lots. 240 to the $6,000, the ones that sell for $6,000, and 360 to the ones that sell for $4,500. Okay, then I divide it by the number of lots, so all $4,000 spread between 100 lots gives you 4,000, etc. So notice they cost me 4,000, I'm selling for 10. They cost me 2,400, I'm selling for 6, etc. So next year, let's say I sell 77 of the A, 80 and 100. So my cost per lot just comes straight down here. So my total cost is 77 times 4,000 is 308. Do the same process there. My selling price is 77 times 10,000, so 770,000. 80 times 6,000. So this is my selling price. These are my costs. So this is my gross profit on it. So my income statement, I total them up. My sales are 1.7 million. 680,000 gives me a gross profit of 1.2. And so I'm just allocating it. If I note the inventory is, I had 100 lots, I sold 77 of them, so I have 23 lots at a value of $4,000. So I can multiply out and get my inventory. The next topic I'm going to talk about is purchase commitments. A purchase commitment is just exactly that, if I commit to purchase something. So let's say that I'm a trucking company and I agreed to purchase fuel and I signed an agreement to buy that fuel during the next year for $3 a gallon. Okay? So as you can see, if I've agreed to pay $3 a gallon for an entire year, if the price goes above $3 a gallon, I am better off. And if the market price goes below $3 a gallon, I am worse off. So the question is, does that fluctuation in the market price of gasoline affect my financial statements? Okay? And the answer is yes, it does sometimes. Okay, so purchase commitment. What is it and why is it important? Okay, a purchase commitment is when I commit to purchase. So notice an entry usually, let me say that again. An entry doesn't get made until title passes. but I have signed an agreement to buy X gallons of gasoline within the next year. Title will not pass until I take delivery of that gasoline. And so notice that if I only use, if I've bought 1,000,000 gallons of gasoline and I only use 100,000 gallons a month, title is passing each month when I buy the 100,000 gallons. And but what do I do with that commitment? So what is it? I've committed to purchase. So what happens when the market changes? Here's a very important part. I only record losses. Okay, so we'll go through one. They signed a timber cutting contract to be executed in 2021 at a price of $10 million. Assume that, this is right there. Okay, assume further that the market price of the timber cutting rights drops to $7 million. So in other words, I've got to pay $10 million for something. If I hadn't signed an agreement, I could have bought it for $7 million. So I'm $3 million worse off. And so notice what gets recorded is not the 10, not the 7, only the drop in price. So I record losses. So I am worse off. So think about that way. Would you rather pay 10 million or 7? I would rather pay 7, but I've agreed to pay 10, so I have a loss. So I have an unrealized holding gain or loss. This dash income simply means it goes on the income statement. You don't have to put that there. And then I have an estimated liability on purchase commitments. So I'm worse off, so I have a liability. Or if you think about it, liabilities are credits, assets are debits. In this case, I do not have an asset because I only record losses. So I've lost $3 million. Okay? That's right there. So notice this goes in other expenses on the income statement, and that's a current liability. Then, when they cut the timber and they pay $10 million, I debit my timber inventory for $7 million. I credit cash for $10 million, and then I get rid of my liability. What this does, this really honestly wouldn't matter if this happened within 1 year. The only reason I'm making this entry right there is because year ends on December 31st, and I need this loss in 2020 because it happened in 2020. If this happened in January of 2021 and then I bought it in February of 2021, I wouldn't make this entry. So I only adjust purchase commitments at year end. So when they cut the timber, this is what happens. So then, now assume Congress permits St. Regis to reduce its contract price and therefore its commitment by $1 million. So I just go back to this entry and I flip it for the $1 million that I'm no longer committed to buy, or that don't have to pay it anymore. So I just flip it for the $1 million. Okay? And we already talked about that. Where do they go? Other expenses and current liabilities. Okay, gross profit method. I just kind of want to show you, you know how to do it. But beginning inventory plus purchases equals total goods to be accounted for. You know that. Goods not sold must be on hand. Sales reduced to cost, deducted from the opening, blah, 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 et cetera, et cetera. I'll talk about that. Okay, so let me ask you this. What happens if, this is why I don't really like this statement, goods not sold must be on hand. They don't really have to be on hand. Okay, so the gross profit method is oftentimes used when inventory burns up and I don't have my inventory on hand. Insurance companies will use this, all right? So I do, however, have my records. And the reason I have my records, even though my inventory is burned up, is because we have proper risk management procedures where we have our records stored in an off-premises location, and we also have backups of them, so I have my records. So my records show beginning inventory of $600,000 and I purchased $200,000. Sales at selling price are $280,000 and the gross profit is 30%. Okay, so this is how your book does it. This is how your homework does it. I'll show you how I do it, which then I'll show you how it's exactly the same. But we all know two things. I've asked you over and over and over these. What is a cost of goods sold statement and what is a multi-step income statement? And we know a cost of goods sold statement is beginning inventory plus purchases equals available minus ending inventory is cost of goods sold. And we know an income statement is sales minus cost of goods sold is gross profit minus operating expenses is net income. And go ahead and write that out. We don't really need this part. You don't have to put not needed. Just know I'm solving for ending inventory. So, once I get my number, I don't have to fill out the rest. Okay, now I'm just going to start filling them in. I've circled where we have the numbers. So beginning inventory is 60,000. Purchases are 200,000. That gives me available of 260. So I've got these three. And I know that selling price is 280. And I know my gross profit percentage is 30%. So it's 30% of selling price. So if sales are 100%, gross profit is 30% of the selling price, which makes it 84,000, which makes your cost of goods sold 196,000. If your cost of goods sold is 196,000, I can just pull that right there. Sorry. Do that. My cost of goods sold is 196. Put it right there. And I know available is 260. And cost of goods sold is 196. So I can back into ending inventory of 64. Okay? So notice they basically do it the same way. Beginning inventory plus purchases equals goods available. They simply pull this sales and cost of goods sold over here and then say, okay, of my sales, 280 less my gross profit, 30% of 280,000, 84,000, this number, gives us sales at cost, 196 right there, and I get 64,000. I just prefer to write it like this because I can rattle off one of these very quickly, just fill in the blanks and back into the other part. And so it's relatively pretty easy. So now, again, remember, I get all these from my records. I know my gross profit markup is 30% because I have last year's income statement, the years before income statement. I might have some monthly sales figures, etc. So I give that. Again, this is a ballpark. This is not an exact thing. Okay? Now let me complicate it a little bit more. And let's add some purchase discounts and returns. Okay? So let me figure out this. Okay, so this is this one right here. So it's kind of messed up. Okay, so I have beginning inventory plus purchases equals available minus ending inventory is cost of goods sold. But let's expand the purchases, and purchases are gross purchases minus purchase returns and minus purchase returns minus purchase discounts plus freight in, because every cost to get at the inventory there is added to the cost of the inventory. So gross purchases minus discounts minus returns plus freight in gives me available. So I'm just going to plug these numbers in. We'll get to the 25% of sales and to the 25% of cost in just a second. So 160 plus 640 plus 30,000 for freight in. My sales is 1 million over here. I'll come back to that. Sales returns is 70,000 and purchase discounts is 12. So I have no purchase returns. Sales, the same thing. I take gross sales minus returns and allowances minus discounts to give you net sales. So I have 1,070,000. So those circled things are the given things. Okay. So now compute the inventory, assuming that gross profit is 25% of sales, and then compute the estimating ending inventory, assuming that gross profit is 25% of cost. Okay, you need to read it carefully to make sure you know if the markup is on cost or the markup is on sales. And here's how I do it, then I'll show you how the book does it when we go right back to there, right here, okay? But notice that my cost plus my markup equals selling price. Stop and think about how simple that is. If it costs me $1 and I'm marking it up 50 cents, my selling price is $1.50. It's as simple as that. Okay, so now this one, which you can't see very good, so I'll go over here. Assuming gross profit is 25% of sales. Okay? That's my my markup right here is 25% of sales. Okay? So I have my cost plus my markup, which is 25% of sales, so 25% of the selling price equals my selling price. Okay? This one is what happens if gross profit is 25% of cost. In this case, I have cost plus 25% of cost equals selling price. Okay? So let's just throw the numbers of this particular thing in there and what they give us. So notice that we know that our I'm gonna have to pause this 1 second. Okay, so notice I have sales minus cost of goods sold is gross profit. Okay, so the cost is the cost. This markup is my profit. And the selling price includes the cost plus my profit. Okay? So I like to write it like this, but if you feel better, you can put cost plus profit equals selling price. All right, so notice that in this particular problem, I know that cost of goods sold plus my markup of $232,500 equals my selling price. So I can do my cost of $697,500. Okay, so look at this particular one. This $930,000 is given. It is 25% of selling price. So I take 25% of $930,000 to get $232,500. So my cost equals $930 minus $232,500 or $697. But the 25% of selling price is easy because I can put 100% by selling price, and gross profit is 25%, and cost of goods sold is 75%. Okay, now let's go to the harder one, but let's just write it out here. Remember, I'm given the 930 right there. I know cost plus 25% of cost equals selling price, and I know my selling price is $930,000 total. Okay. If I add cost plus 25% of cost, I get 1.25 cost. So now I know that cost equals 930,000 divided by 1.25, so my cost equals 744,000 right there. Okay? Notice you can also do it like the book does it. So if gross profit is on selling price, if I'm given 25%, the markup on cost is 33%. If the markup on cost is 25%, then the profit on selling price is 20%. I guess you would do it right here. This is given, markup on selling price is given at 25%, so I can back into cost and get 25 divided by 1 plus 0.25 equals 20, which makes some sense because look what I did up here. I took the 930,000 divided by 1.25 instead of the 0.25 to get my 20% right there. Okay, I generally do it overall like this, but feel free to do it the other way. Okay, just make sure you read it closely. Okay, so you can kind of go through that. Notice we have the 120,500 right there. This is their method, which is basically the same. 160, 640 minus 12 plus 30 is 818. Then they go over here. 1 million minus 70 is 930. Then they go to the 232,000, which is 25% of it, and then back into the 697. Bring the 697 there. Subtract it to get 120. So again, the same thing, but since I know how to set these up, I just use it this way. Okay, and then this one, they use 20%. I didn't use 20%. I divided the 930 divided by 1.25 and got the number directly. They took 25% divided by 1.25 and got the percent, and then took the percent times the number, etc. They just added a step. It's the same thing. Okay, just practice it. All right, so what's some problems with the gross profit? It's an estimate. It relies on past percentages. These are past percentages, etc. And a lot of times this is great if the whole thing burns down, but if your inventory's gross profit varies and all your records have overall financial statement, but only a section burned down, it might be difficult. Notice it's normally unacceptable for financial reporting purposes, but there are cases when your inventory is gone, then you have to file insurance, or you have to use it for financial statements. Okay, retail method. Okay, I'm basically going to show you, pause this for a second, and show you a really simple retail method one, and then show you the more complicated ones. Okay, so here's my cost of goods sold statement again, and let's say that in this particular case I want to take inventory for month end. So it's not for formal financial statement purposes, but for month end I want to estimate it. And let's say I'm a store in a clothing store or something. So clothing store, I open till 9 or 10 p.m., but a lot of times between 9 and 10 p.m. or the last hour of the day, there's not much for the store people to do. So I say, well, at the end of the month or a certain day of the month, I want you to count inventory. And how you're going to count inventory is you're going to look at the stack of items, and you're going to write how many is in that stack and write the selling price. So let's just say that I am selling sweatshirts and sweatpants. So I'll count a pile of sweatpants, and I'll say there's 10 sweatpants there at $25. And then there's 25 sweatshirts at $30 or whatever. So what I do is I just write that on my piece of paper because my staff in the store can easily do that. Okay, so remember that. I'm counting my inventory, but notice it's at retail price. So now I have to do is subtract the markup. All right, so what I do is, again, I go to my records, and let's say my cost of my beginning inventory is $52,000. I also know my retail price of it is $78,000. Okay, I know that I purchased during the year. Okay, so I just added. I added purchases during the year of $283,000, and their retail value is $422,000. And so I have available of $335,000 and $500,000. So in other words, my cost is 67% of my retail. Let me see if it's bigger than that. Yep. My cost is 67% of my retail. So now I go around and count. So if you think about it, my ending inventory that I am counting is I'm counting it at retail. I'm counting my ending inventory at retail. So if I count my inventory at retail and I find out it is $96,400, I know that my cost is 67% retail, and so I get $64,588. Simple as that. I can go ahead and figure out my cost of goods sold now if I wanted to, although this problem doesn't always ask for it, but my cost of goods sold would be $274.12. So again, all I do is cost at retail, and I say to myself, cost is 67% of the retail price. If I count my ending inventory at retail price, I can back into my ending inventory at cost. It's as simple as that. Okay? Now I'm going to show you theirs. I'm going to pause this, and there are certain things that complicate these things. I want you to know the more simple method, although you might have some. Okay, so the complicated things on this are purchase returns, additional markups, markup cancellations, markdowns, normal spoilage, and we do have sales because that would be our cost of goods sold in the other ones. All right, so these numbers are the same. The only thing I would encourage you to do on your handout is circle these two and write 7,000 down by it. So it's additional markups and markup cancellations, so these are negative. So put $7,000 on it. Okay, So we have cost and retail. So notice these are some of the same numbers I used in my little example before. I just skipped all these other things. So my beginning inventory is 52 and 78. My purchases are 272 and 43. And honestly, that is where most problems stop, and you just get the percentage and take it times it. Okay, but we all know that freight in is added to the cost of the inventory. Okay, and notice it's under the cost column, so I'm only putting under the cost column things that affect the cost. Okay, and I'll put the retail column numbers over here. Purchase returns are 5,600. They're subtracted. So remember, purchases, we talked about this on the other one. Purchases, less returns and allowances, less discounts, plus freight in equals net purchases. So that's all I've done over here. Purchases plus freight in minus returns gives me net purchases. So beginning inventory plus, beginning inventory plus purchases gives us available for sale. So my 335 is my available for sale. Okay. All right. So my retail, then I have my 78,000 plus 423. Now purchase returns should be a subtraction, so they're 8,000. Additional markups. Remember, I told you to put 7,000 right next to that. Okay. So these two are 7,000. This one. Okay, so now I get 422 of purchases, so 78,000 plus net purchases is 500,000, so 335 divided by 500 is 67,000. Then markdowns, these are done on the selling price. Okay, so I'm simply going to take sales of 390,000. I'm subtracting that. Remember, let me go back to the other one here a second. 1 second. Okay. Notice that right here, if they gave me if they gave me sales at retail, this is sales at retail right here, because the cost of the goods that are sold, the retail price of the cost of the goods that are sold, the retail selling price of the cost of the goods that are sold are sales. So this problem is giving us this one. Then I back into this one and take 67% of it. Okay, so this number right there is sales. So think about it. The retail price of cost of goods sold is my selling price. Okay, so let me get back. That's what they're giving you here. Okay, so notice that, so we take the 50,000, 500,000, and on it we subtract the markdowns of 36, 10,000 in sales. I get my ending inventory at retail. I did them side by side above. So I take 67% of that, and I get 644,588. Okay, now there's two methods to this. Please know there are two methods. Please know the name of the two methods. The two methods are the conventional method and the cost method. Okay? On this, what I will test you over is you will have to do one of the two methods, and it will be much simpler than these problems. Okay? So just know that you would add freight in minus purchase returns. Markup, you're marking them up on cost. You're marking them down off the selling price, etc. But notice the only difference between the conventional method and the cost method. Get it to move here, there. Is where they put this 3,600 down, the markdowns. In the conventional method, they put them down below the percentage. And over here, the only difference between this pane under the cost method and this one under the conventional method is this 3,600 is down here, this 3,600 is up here. Okay? Every other number is exactly the same. Okay? So, what I look at it and do is say, okay, we went from 67.49% to 67. Our journal entry is our inventory at cost is 65,056 compared to 64,588. Okay, that difference is $468. Well, $468 divided by like $65,000 is 0.0072. So 0.72% difference. Okay. In other words, I don't care which one you use. They're both very close. They're both acceptable methods. Both of them, in essence, adjust because at retail I'm marking some down. I have my purchases. I have my selling price. I have some spoilage, etc. It takes all those into account. So kind of become familiar with them, but probably whichever method you do is fine. Don't spend a lot of time on the notice. Really, I would probably know this one, okay? Because I think I could say, oh, I'm going to put everything above the available for sale except for spoilage and sales, and that makes sense to me to put sales and spoilage below that because I have nothing to do with costs, the spoilage. It's the items that are sold. Okay, but anyway, so just kind of know that it's not that incredibly important. Okay, so you can ask me questions on that. Retail method, we talked about those. You did one. Don't really have anything to add. That's just another example. Okay, so notice you can compute inventory without a physical count of the inventory, control measures to determine shortage. So you can do test figures as you go along. Notice in my method, my example and the other one, I sent my salesperson around to count inventory. But notice I wouldn't even necessarily have to do that. I could back into my ending inventory just based on my sales amount, because I could determine, go back there, I could determine sales, this is sales again, from my register, because sales at retail, if I took 67% of those, I'm going to get my cost of goods sold. So I could use my checkout register tape to determine sales, back into that, and then just back into the only unknown that I have, which is my ending inventory there at cost. Okay, so it's very quick, so you can do it for interim financial statements. You can also kind of say, all right, that's what my ending inventory should be, and maybe I do want to go count it if I suspect theft or something like that. All right, how to explain and analyze inventory. Okay, so think about what you want to know in the financial statement notes. You want to know what inventory is composed of, what types of inventory you have. You also have to be consistent. Well, financing. Financing means is it used as collateral for a loan? How is it part of a financing arrangement for something else? What costing methods are you using? FIFO, LIFO, average costing. You need to be consistent. You have to stay with FIFO unless you have a really good reason to change. And if you do change, there's a lot of disclosures. You have to have the composition of inventory, which means raw materials, work in process, finished goods. Any significant or unusual financing arrangements, I've already got that. You have to disclose if it's pledged as collateral for a loan, and we've already talked about the basis. The last thing in this chapter are some ratios. The two ratios that pertain to inventory is inventory turnover and days to sell inventory. Inventory turnover is cost of goods sold divided by average inventory. So I have beginning inventory of 1.38 million, ending inventory of 1.17. So my average inventory is beginning plus ending divided by 2. Sometimes people say last year plus this year divided by 2 because Last year's ending inventory is this year's beginning inventory. So I take cost of goods sold divided by average inventory, and I say we're turning over our inventory 6.44 times a year. So if we sold and restocked our inventory, we sold it all, then restocked it, sold it all, then restocked it, we would do that process 6.44 times a year. Then you can think about, all right, if we turn over our inventory 12 times a year, how long is it staying on the shelf? Well, 12 times a year it would stay on the shelf about, yes, 30 days, a month, right? So it makes sense that if it's turning over around 6 times a year, this one is close to 60. So the days to sell inventory is approximately how long inventory stays on the shelf. So you take 365 divided by the inventory turnover, you get 56.7 days. So most of the time this one's easier to understand, although in business they talk about that lingo more often. Okay, so 56.7 days, and you are not responsible for the appendix, and we are done. Congratulations, you are finished.